Yeah, just looking at it, like I think about the model back in the day. I mean, for turnkey, you'd have a buyer looking at a couple $100,000 in with 20% down, and they'd make like $500-600 in cash.
Right.
You know, now this is actually better than that.
That's right.
You know, on a cash on cash. You know, this would be very attractive for a lot of people. Obviously, there's a little bit more of a layer in that to be a buyer of a multifamily, CMHC is going to want to probably see, and the lender's going to want to see that you have some ability to own such an asset.
Yes.
Welcome back to REI Hot Seat. Andrew Hines here with David Hulshof. Here again. Really happy to have you here, Dave. I feel like we do the most together now. It used to be Jake.
Yeah,
and
I've taken his throne.
You've taken his throne, for sure.
So I'm the resident sit in now. Yeah, I like
He's
it.
the resident on the show
here.
now. Okay, so Dave's obviously a wealth of value here, wealth of knowledge when it comes to multifamily and creative buying strategies, creative selling.
Yeah.
You know, we're talking about stuff all the time about how to see a deal through start to finish. And one of the things I love best about what you guys do is you look at a deal, and when you're trying to give a seller a value, you actually put yourself in the buyer's shoes, walk through the entire process. Who's our buyer? How would they get to the point of buying this? And then you engineer the deal backwards from there.
Yeah, we actually just did that. We did an opinion of value on a vacant building in Hamilton that we're probably going to bring to market and off market. Yeah. And we did exactly that. So he had a certain number in mind, and when we ran through using his construction numbers and his numbers, by the end of it, it's like, you want this, you can see how as the buyer they would really be here. And I say, yeah, okay. So it really helps, right?
Do you ask him if he would buy it? Would you buy this?
All the time. Yeah. And it's like, it's not trying to get you. It's just, hey, if we use your numbers, somebody's going to go through all of this to leave that much money in the deal. And, you know, in contrast, here's a similar building. Here's what it's priced for. We put in the data. Why would somebody do that? Like, the market is somewhat efficient in that respect.
Yeah, I love those questions where you let somebody answer the question for themselves. Why would somebody do this? Right. I feel like that's so much more impactful. And that's obviously a big part of it, right? I mean, obviously every seller wants to get the most possible, but you got to put it into reality.
And a lot of times people come to us, right, the insiders, and they just don't know. Like, he thought he had a good handle on it, right? And, you know, the markets are shifting pretty quickly these days. So when you can kind of layer on the data and show them, it makes it a little bit easier. So we got him to where he needed to go. And, you know, I think when you do it that way, you can structure fair deals for both sides.
Yeah, it makes sense. And those fair deals these days seem to include some cash flow. So
finally,
hoping we have one here today. So the one we have here today, I can see it's a 12 unit.
Yep.
We've got a listing price of 4.5. Is this listed right now?
It is off-market opportunity.
Okay. Yeah. So describe to me what it is. Is it purpose-built? Is it townhouses?
Yeah, and I'll show some photos after. So it's 6 and 6. So it's 12 townhomes.
Okay.
There's a big courtyard in between, in the middle. So one side is, they're all 2-story walk-ups, but one has garages, and then the other ones don't.
Okay.
Okay. Everything's metered, hydro, water, everything. So the utility cost as the owner is actually zero.
There's an actual zero utility
cost. An actual
cost.
Zero, yes.
That's amazing.
Yes. In fact, there are no even street lights. The lights are run on the individual properties.
On the individual tenant properties.
Yeah. None.
Wow, that's the way you like it. Simplicity. And I really love simplicity.
Yeah, these are a nice asset. Yeah, this is good.
Okay, so approximate location, can we say?
Yeah, it's in Walkerton. It's 12 townhomes in Walkerton. Address is on there as well.
Okay. And this one you mentioned off camera to me, that's a bit of a unique opportunity. Just describe the circumstance in which a buyer would be coming into this one.
Yeah, so what makes it unique, without going too far in the weeds, is there was a time with CMHC that you could get 100 points in energy efficiency through MLI Select, and we've talked about it many times. They've since changed that rule. So that was the kind of the crown jewel, right? That was the 95% loan to value, 50-year amortization.
50-year
right? So they were working through tenant negotiations, full renovation, and the idea was turning around to sell these, and the new purchaser was actually going to put that debt on themselves. And in that transition, as CMHC started to make those changes, the vendors decided to actually go through the process to get that themselves.
Yeah, to not miss the deadline.
Can't miss the deadline.
Yeah, so to not miss the deadline, get that 100 points so you can get the full 45 year or 50 years.
50 year, yeah.
And 95% loan to value.
Crazy.
Yeah.
So the debt has now been funded. Mm-hmm. So the approval was in place, and there was a bit of a timing of, hey, when do we pull the trigger, basically. So the deal has now been funded. So what makes it unique is, obvious besides the utilities, is you're actually assuming existing debt.
Yeah.
And it's a little bit below 95% loan to value.
A little below.
Yeah.
Nice.
So and we'll run through the numbers, but
yeah,
if my math is correct, I think we're about $450,000 on a $4.5 million purchase price. And that includes, land transfer, all that fun stuff.
All right. $450,000 in on $4.5 million purchase price.
Yeah.
10%?
But so the debt's going to be like 92, 93.
Yeah.
But then there's the land transfer.
Yeah, all your closing costs. Right? Okay, yeah.
And we're talking about, so there's also I always put in legals, and I assume you're going to do reports. Yeah. So this has a phase one that's clean, so you're probably not going to do it, but we just throw it in, right?
Gotcha.
The worst thing you'd want to do is say, hey, look, you need $380,000, and somebody goes, okay, I have $380,000. And
this is the thing. Like, so many people just say, oh, what's the down payment? Well, they'll give you 95%. Okay, so 5%. Like, no, you got to build in all the closing costs. I like that you guys do that. Obviously, it's part of the system.
Yeah.
Something I started building into my numbers many, many years ago is like, you need way more than just your down payment.
Always.
Yeah. You need operating capital. And then of course, due diligence capital in this case.
Yeah.
But like you said, so you already have the reports because
all the reports are there because everything's been funded.
Okay.
Right.
Perfect.
And even for example, just to go in general terms on deals, like we'll put in a 1% lender fee, a 1% broker fee.
Yeah.
Right. So just for context, it's, the lender that's going to get paid, the broker who's doing all the work. Doesn't mean you're actually going to pay that, but better to have it on it.
Oh, I agree.
The numbers that way, right?
Yeah, I agree. Okay, so let's take a look at the pictures before we get into the numbers. I love putting a visual on stuff.
So let me know if you can see this here. So basically what they've done, 10 of 12 are fully renovated. There's still 2 legacy tenants, which we can go over.
Yeah.
What they did was they hired an interior designer, which I think is a really smart idea. Just as a side, a lot of times what happens is owner-operators are picking the floors and picking layouts. And, the challenge is you're wearing perhaps too many hats.
Right.
So they ended up hiring interior designers. And actually the designers were instrumental in saying, hey, let's pull that wall down and move that over here. And so you see some really cool usable space and some really some nice colors.
Well, this looks really good, this picture.
Yeah, they're really, it's a kind of a high-end.
You got quartz, you got backsplashes.
Yeah, exactly.
So there's baseboards in there, but they have heat pumps, I'm guessing, for the efficiency.
There's a heat pump right there.
Yeah. Okay. So they have baseboards as backup.
You got it. Yeah.
Okay.
Supplementary. I mean, it can get cold out there. Probably even colder in Walkerton. Let's see here. Let's go here. So this is one of the smaller units.
So you're saying 10 out of 12 are finished like this?
You got it. Yeah.
Okay.
So this is this would be the non-garage side, just as a reference.
Okay. And how many square feet would these units be, approximately?
1,000.
1,000? Okay. Yeah. And they're mostly 2 beds?
Yeah. So there's, here, I'll go to it. Right. So there's 2s and 3s, mostly 2s.
Mostly 2s. Yeah. Okay.
So what you end up seeing is on the garage side, the 2 end units are very, very large.
Okay.
So one was actually designed for the builder, the guy who built them, and then the other one. So those are the only 3 beds.
Gotcha. That makes sense. Okay, so that would actually, those would be your 2700s, the 3 beds.
You got it. So let's do an exterior. That might help here. So you'll see 6 here,
perspective shot,
6 there. This is actually a garage that has power to it.
Okay,
it's actually the same length and width. You just, there's talks about potentially making that a unit. I think Walkerton's pretty bullish on adding units.
Okay,
so that's a conversation piece. Yep. So this is the courtyard, obviously, and then that's the garage side. And then obviously there's some additional space.
Perfect.
Okay.
All right. Yeah. So let's look at these numbers. So you said there's a couple of legacy tenants. Do we have any vacancies right now?
No vacancies right now.
So number 3 says vacant, not anymore?
That is not vacant anymore, and this is tenanted.
5 is not vacant. 3 is not vacant. Okay.
Correct. So this might be a little.
So did they
outdated.
get their They got their 2,000.
Yep.
Okay.
Yep.
And
Yeah, and there's some good precedent for this. It's crazy. Just as a side, again, why I'm so bullish for all things near Bruce Power. You get a really well done unit, but $2,700 a month. Like that's fantastic rental income.
that's great rental income. I mean, that's I didn't think you could get that much out there.
Nobody does until they go out there, and then
Yeah.
$2,500, and those are signed, like those are paying tenants.
Yeah, and you got $555 there in unit 2.
The vast majority of these were like $600-700.
That's hilarious. Which just like 10 years ago wouldn't have been that outrageous.
Yeah.
Well, it still would have been bad, but it wouldn't have been outrageous.
Yeah.
Now it's outrageous.
It's
Yeah.
totally outrageous. Yeah. So this particular tenant is Legacy. Obviously, he's very helpful. Does a lot around the area. He's in poor health right now, and then this is a younger couple. They're open to chatting about leaving, but when you get into it, is it worth it from a spread to market perspective?
Yeah,
'Cause
looking
they
at
would
the
be looking
payback.
for money to leave.
Yeah. Like, are we talking like 10 G's kind of thing?
I think they want 20. Yeah. So you can quantify the math if it's worth it. Right?
Yeah, that's still a good return on investment at $882 a month.
Yeah.
Which, I mean, if they're a smart tenant, they kind of know that. Interesting. Okay, so let's look at the rest of the numbers here.
Yeah, so there's some parking and some storage. So that storage is what they're getting for the garage, which is
150.
incredibly low. You know me with storage.
It's a big, you could split that up into multiple storage and then you'd be getting more, right?
Yeah, that's for a whole garage with power to it.
So would you put lockers in it and then just...
I mean, I think there's a world where you actually make it a unit. I really do. But I would, if I'm not going that route, I would absolutely add
Section it up,
put some doors and stuff. We've talked about it.
You can even do that with 2x4s, really, right?
Yeah,
you
it's super easy.
You could just 2x4 frame the whole walls, frame walls down in between, put plywood up on them, setting doors with padlocks on them.
It very easy to do, and even in some of these smaller communities, there's big need for storage. We talked about it all the time, but I have yet to come across a place where they have a bunch of storage that it's not being utilized.
Yeah, so if there's 12 units, you'd foreseeably try and make 12 storage lockers and charge $50 a piece.
Yeah.
That
great.
adds up.
Yeah, and then a little bit of parking income. So taxes, property management, there is no utility cost. That's accurate. Vacancy, grass cutting, snow removal, insurance, maintenance, and labor. We talk about this a lot.
Wow, those are low expenses. That's crazy.
Beautiful, absolutely beautiful. So, when you look at maintenance and labor, when 10 of 12 has everything brand new, including windows, doors, you name it, you're not going to get that. It's a new roof, like everything's done. But as a safety measure, I was talking about this earlier today, actually, is, good practice is you take that money, you throw it into an account, you have a slush fund.
Yeah.
Very dependent on who you are and your risk tolerance. But for me, I'd probably like to see $25,000 just sitting in an account for a rainy day. Once you have that, you can take it out. I don't think
that's how I was with all my student rentals over the years. Like I said I'd get them to 10, but then I got them to 10. I'm like, nah, just let them get to 20. Let them get to 20.
We're savers, right? Yeah.
That feels real comfortable.
Yeah. Then then
you never at night, you get a call from a tenant. Just call the plumber. Like, I don't want to hear about it. You know what I mean? Like, you have no worry about it. No. You know that these take care of themselves. Like, they're sound business assets. Like, just that's the way to run them, in my opinion.
Yeah. So when we go to layering on the debt here, let me just move over. So $4.5 million purchase price. This is pretty close to where the loan is. Okay. Some of this perhaps might need to be updated a little bit, but
approximate. Okay.
Approximate. We've got land transfer tax. You've got your down payment. You've got other closings and legals. That's definitely high. There's no CMHC application fee, I don't believe. Although, actually, there might be for the assignment. So that's probably what that is. So forgive me there. That brings you to about 93%. That's the actual rate, 4.35.
Okay.
Which where we are today is, really good.
That's what length of term?
10 year.
10 year. Okay.
So that's probably, I'm guessing we could pull it up, but probably 60 basis points above this 10-year CMB right now. So that's like a very attractive rate.
Yeah.
Because rates have gone a little bit in the other direction.
They've gone a little bit up lately?
Yeah.
Okay.
So, anyways.
Oil's gone up a bit lately, too.
Right. So a very, very competitive rate.
So positive cash flow on this one, 2,200 basically a month.
You got it.
Yeah.
So a 1.13 debt cover. If you remember from MLI Select, you need a 1.1. So a little bit in the positive. Your cash on cash is a little over 6% as is with purchase. And big reason we get there is because
you're
utilities.
Well, yeah, and
Strong
limited down payment, right? Like your cash on cash looks better on this than typically because of that. So, I mean, in this one, you're gonna let the account build up to 20,000, 30,000. It won't take that long with that kind of cash flow.
No,
shouldn't.
No, and again, this is a sort of a set it and forget it. We have property managers because that's one of the questions, right? When you get out towards Bruce Power, who are the property managers? We have people for that if you want. This is kind of an asset where it's pretty easy, so you may consider just doing it yourself, which would obviously help with the cash flow. But it's more of just a get it, set it, and forget it. And then when those other two tenants eventually leave, you're going to get that cash flow. And then if you're as adventurous as one could be, you may want to look into something for the garage.
Question: Why sell this?
Yeah, well, I mean, so the model for the ownership group is about taking underperforming assets, adding value to them, and then disposing of them and continue.
Yeah, do it again.
You got it.
But you could take the Burr method as an owner with this too.
Yeah.
I mean, effectively, that's been done already.
Correct.
I mean, less the 7% that remains in the deal, which isn't nothing on 4.5 million.
Yeah, exactly. Yeah. Like the idea is just more allocating your time and resources towards this is the thing. Like if you're a value add person, side note, we got an opportunity for a small little 6 unit. The guy did all the value add to it, got him a stellar deal, and he decided he wanted to keep it. And the conversation was, encouraging. You're happy with the deal. That's great. But are you a value add or a turnkey guy? Because his whole model, this was his first foray into multifamily, was value add. I want to add value. I want to add value.
Yeah.
He did it. He gets a home run and he wants to keep it. And for that particular individual, that's it. He can't continue.
Yeah, because that's his money, his capital.
Yeah. So it's like, okay, has something changed, right? So for him, it has the circumstances. For these guys, it actually hasn't. So they're, dispose of it, continue moving. Not a lot of flexibility on price for that exact reason, right? They're not going to.
Because they could just as easily keep it.
Correct.
Just looking at it, like I think about the model back in the day. I mean, for turnkey, you'd have a buyer looking at a couple $100,000 in with 20% down, and they'd make like $500-600 in cash.
Right.
Now this is actually better than that.
That's right.
On a cash on cash. This would be very attractive for a lot of people. Obviously, there's a little bit more of a layer in that to be a buyer of a multifamily, CMHC is going to want to probably see, and the lender's going to want to see that you have some ability to own such an asset.
Yes.
It's a little bit more of a barrier to entry than a typical.
Yeah. And that'll be kind of the part of the deep dive on this. So this won't be hitting the market. This will be off market. It's just starting to be kind of pushed out now to the insider group. And that's kind of going to be part of the conversation is obviously where's the money coming from, and do you have enough net worth? And without going too far into it, there's ways to mitigate it. So I don't want to get.
What are they looking for? Like high level, what would sort of your entry point be to get accepted into a CMHC program like this, and then also satisfy the lender's net worth requirements? Yeah.
So the size of the deal, you would need at least 25% of that. Sorry, the size of the loan, 25% of that in net worth. Okay. This one's a little bit different. When you're doing an assumption of debt, and I don't want this to get taken with this deal because then it's like baby with the bathwater. But in most circumstances, when you're assuming debt, the lender is going to want you to be as strong as the borrower. Right? Okay, so if you think, let's use you and me, let's say you have an abundance of money and I'm poor and I'm trying to take over your thing and I have no money. Right?
The lender's
not going to want that because I'm not a good covenant. So one of the things with a deal like this, as an example, is the current ownership group has a very strong net worth. The actual individual Untitled is a strong net worth. So we have ways to mitigate that. So one of the ways would be they stay on, you assume the debt, and you have some structure to it. Right? But I don't want to get too lost in that because I don't want that to be the hinge point of people not wanting to reach out and learn more about the deal.
Yeah, but there's a way.
I mean, look, we're good at it. There's always a way. But the idea would be most of the time when you're assuming debt, you would have to be of equal value on paper.
Gotcha. That's handy stuff to know, right? Like we've talked a lot about the program, what its benefits are, but like getting in and satisfying the requirements is obviously another one. From a lender standpoint, just from even back in the day from brokering some of this stuff, I know a big part of it is they want to see that you have income and don't rely on the income from the deal. It's not like they're factoring in your income in a ratio, but they're making sure that you don't need to live off of the building. They're going to want to see that, ideally you have some experience with properties and have qualification to run such a thing.
Yeah, exactly.
Like the story makes sense.
Yeah. Like I own a mixed use property downtown Burlington, and that's one of the criteria the banks don't love mixed use, right? One commercial, one res, owner occupied, right? It's not, they don't love it. So that was just one way to mitigate it, is like, instead of going through all this weeds of, hey, what's the rental income and stress testing the leases it's just like, hey, can you carry the debt on your own? Oh, you can? Okay, well, that's an easier solution then.
Oh, okay.
Do you know what I mean? It just makes it easier. Yeah.
So they'll take a make sense approach to that stuff. But that wasn't involving CMHC. Obviously with CMHC, it's a little more structured.
Yeah, you got it.
Cool. All right. Well, this is a very interesting turnkey sort of set it and forget it deal. Looks like the cash flow is certainly decent, and then obviously there's room for lift there.
You got it.
One of what you don't see when you look at these numbers is it could start here, and then as you get, hopefully rental increases in the next 10 years, and then other ways to increase rent, such as adding in additional income earning things, adding in a unit, building lockers is the cheapest way to add like $600-700 of income.
Yeah, if you look at it, like if two of the tenants, if that were today, it's $2,300 a month plus another, what'd you say, $500-600?
Yeah, your dollar for dollar, when those units turn over, that's an extra $2,000.
Yeah. And
then you've got the lock. So you could add between that and the lockers, you're close to $3,000 you could add. Yeah. Is there an opportunity to add more parking income here?
There is, but I think the way it's structured, I would say no, just because if you look at some of the rents, they're pretty strong, and I don't think you want to displace the tenants too much.
Yeah,
so I think that would most of the time I'm like a pit bull with the parking. I think in this circumstance, I would look more towards the the tenant turning if they're open to the conversation and the storage. But I mean, $3,000 a month is pretty substantial.
Yeah, that's significant. $3,000 a month. That's $36,000 a year. I mean, adding on to the $26,000 it currently makes. I mean, if you just think about what that does from a cap rate and value, you're effectively, you're not doubling operating income, but you are doubling your cash flow. So that's awesome.
Pretty substantial. Yeah. So it's a hybrid.
That's a big value add.
Yeah. Huge. Yeah. Absolutely.
Awesome. Okay, Dave, anything else we should take away from this one?
No, we've been doing a lot of more and more as we keep going away from Christmas and New Year's. We're getting more and more insiders doing a lot of those calls. They're going great, which is awesome. We're loving helping people.
Awesome. Yeah. So if you're interested in the type of stuff we've talked about, obviously, we nerd out, we dig in deep. We're super niche on this show, obviously. Yeah. But if this is the stuff you're interested in, join the insiders list. It gets you access to these off-market deals. It gets you in a conversation with one of the members of the team here. It could be Dave, could be Jake, or somebody else. Most importantly, you're going to get access to things you just wouldn't have access to otherwise, and knowledge you wouldn't have otherwise potentially.
Yeah. Intake calls. We share an analysis sheet. And then we're doing a lot of opinion of values for guys that are looking to potentially sell as well. So
very nice. All right. So if you made it this far, please take a moment and show our channel some love. If you're on any of the podcast platforms, of course, rate it, review it 5 stars. We really appreciate it. And share the show with somebody you think it would benefit. We just love to see this thing growing. And thanks again. We'll see you next week.
Appreciate it. Thanks for having me on.
Thanks, Dave.